Reading price charts, bar by bar. The technical analysis of price action for the serious trader. Chapter 11, the first hour. Table of contents. Patterns related to the pre-market. Patterns related to yesterday. Trend bar on gap open, first or second bar. Gap openings, reversals and continuations. Trend from the open or trend from the first bar. Third bar of the day in the 15-minute close. Strong trend bars in the first hour often predict strength later in the day in the same direction. Opening patterns and reversals, double bottoms and double top flags, trading range breakouts, first pullback. Patterns related to the pre-market. When deciding what chart to trade, pre-market or regular trading hours, it's best to pick one and just stick to it. It's difficult to quickly analyze both charts at the open. Since the open is very fast, traders should be okay with missing the occasional signal. This is the pre-market, this black box, and then this is the regular trading hours. There are a few signals here, but it's also easy to get chopped up, and this range is very small. So here are the signals. We can buy the EMAs, buy the dips, or short into the EMA. And if you're going to do a counter trend, you have to be fast to scalp out in case it turns around on you. Here's a good short into support, and then you can buy. It's very back and forth price action, and if you look here, you get a surge up, sideways. Compared to the regular trading hours, buy the EMAs, you're buying breakouts, and it's going more in your favor. So you should be okay with missing the harder trades for the easier trades during the regular trading hours. Patterns related to yesterday. Any trades within the first hour are related to patterns from the previous day. Breakouts, failed breakouts, and reversals from the previous day could be completed within the first hour. Sometimes these patterns move to an extreme for the day. Daily chart traders place orders around the previous day's high, low, and close. That makes these levels important. Patterns related to yesterday. So here we have a wedge bottom in the beginning of yesterday's price action, and we have a breakout. Deep pullback, and then today, this line here is the separation. We have a gap up, sell off into the EMA, which is acting as support, and this trend line from yesterday is still intact today. It was respected at the EOD. Here's a pattern that's also followed by yesterday, but it's range. So yesterday was mostly a range day with small selling, big reversal bar on support, and then the market went more sideways. Here, there's three legs up, leg one, pullback leg two, pullback leg three, but very deep pullbacks. So it's more sideways than up. Every time there was a new high, there was a new low. So this range, if you got trapped in it, yesterday's price action could help you out a little bit. Trend bar on gap open, first or second bar. When there is a gap open and the first bar is a trend bar, this can lead to a move. Even if there isn't a gap at the open, a trend bar from the open can set up for a good trade. The chances of it working increase if there is a gap. The reason it has a better chance of working is because the market is overdone. Trend bar on gap open, first or second bar. So a trend bar is a bar that has more body than tail. So this black bar, that's a trend bar, and this bar right here, that would be a range bar. So when we see a trend bar at the open, right here, we can look for a trend. Here we had continuation and then a pullback, it reversed lower and sold off all day. Gap openings, reversals, and continuations. Large gaps at the open represent extreme behavior. These gaps can lead to continuations or reversals. The direction of the gap doesn't dictate the direction of the trend. The gap could either continue or reverse. The first few bars can help us determine what the market is doing. Sometimes it takes up to an hour to see a continuation from a gap open. Gap openings, bullish. So this is a reversal. Big gap down with continuation, but then the bulls get a higher low, which is also a head and shoulders breakout above the EMA, and we trend higher all day. Extreme price action at the end of the day is climactic. So gap opening is bearish. You have a gap up, bear bar. Maybe you're looking for a continuation on these two bull bars, but then look at this bar, strong breakout below the higher time frame EMA with continuation onto the lower time frame. We go sideways and we make a double top bear flag. So this could be that sideways price action for about an hour, I think you could still be short here and holding. Maybe you get out and get short again, and you catch the trend. Trend from the open or trend from the first bar. Sometimes when the first bar is a trend bar, it could become the high or low of the day. This bar could lead to a trend. If the market goes sideways and then trends at the open, this still counts as a trend from the open. The sideways price action could be a pullback. Trend from the open or trend from the first bar. You have a gap up with continuation, but then we go sideways for about 30 minutes. Here we see the bulls race up and sell off, and then they get trapped, so they buy lower and this starts the trend. We break out and start trending all day. We can see that yesterday the bulls also bought the EMA, so off when the day on the open we should be bullish or thinking about being bullish. We don't have to buy the market, but we don't. It wouldn't be good to be shorting these weak bear bars. Third bar of the day and the 15-minute close. After the third bar prints on the 5-minute chart, this creates a 15-minute first bar. This can create action around the third bar of the day. This doesn't mean form a trade around the third bar of the day, but it could have some significance. If the first two bars of the day are bearish and the third bar of the day is a doji, this could be a bear bar trend from the open on the 15-minute. So I just wanted to show how we would look at the 15-minute chart, the 5-minute and the 15-minute compared. These are the same charts. This red line and this red, so this is bar 1 and this is bar 3. This is bar 2 and that's the high and the low. So the low of bar 1 and the high of bar 2 would form this doji because bar 3 is an inside bar, so there's no extreme. So bar 6, when bar 6 prints, this now we're looking at this doji here. Excuse me, this bar here. It's the low of bar 4 and the high of bar 5, and bar 6 is the inside bar. So this blue line lines up with this blue line and this blue line. So the 15-minute chart was a range day, and we got more range bound price action. Same thing with the 5-minute. More range, more sideways price action, and was more rangy right here. Strong trend bars in the first hour. Strong bars at the open can lead to a good swing. These are most common with gap openings. If the first few bars start to reverse, the first bar of the day could become an extreme. If the market starts to pull back at the open, it could form a double top or a double bottom that leads to a swing in that direction of the gap. Strong trend bar, bullish. So I wanted to show the double bottom. We have a gap down. The strong trend bar is bearish, but no continuation. The bears that get short here, short higher, they get out here. When bears buy back their shorts, the bulls buy the double bottom, and that's strong enough to start the trend. Strong trend bar bearish. So here we have a gap up and a failure. This is pretty bad looking for the bulls if they wanted to buy, and they don't. We don't see any bull bars, and we sell off into the EMA and then go sideways. After the sideways price action, we break out of the range and sell off for the rest of the day. Opening patterns and reversals. The moves at the open may be faster. However, they should be treated as any other price action pattern. Sometimes the market will trend from the previous day's extreme and reverse. This may look like a breakout, but can lead to a good swing in the opposite direction. Opening patterns and reversals bullish. So here we have a big gap up and a strong sell-off and a sharp reversal higher. I think a lot of bears got trapped here, and this bar looked good enough for the bulls to buy, and they got a few legs higher. A very deep pullback and went range bound with more bullish price action. Opening patterns and reversals bearish. Here we have a bull trend. Sharp sell by 2 legs, leg 1, pullback leg 2, reverse into the EMA. The next day, we have a doji bar with a huge tail. So bulls rallied, bears got short, and I think bulls got trapped with bar 2. When they saw no continuation, they hit out of their longs, and this created a double top. Bears are selling highs, bulls are selling highs, and this creates a very strong trend. Leg 1, pullback leg 2, pullback leg 3. Double bottom and double top flags. Double bottom and double tops show the market has tried to move in one direction twice and failed. Double bottoms and double tops could be seen as a reversal pattern. However, in a trend, they are with trend trades. They form after the move has already begun. So here is the first breakout and a pullback. If you miss any of these trades, there's a double bottom here on the EMA you can enter on, a double bottom bull flag. I actually did take this trade live. It was nice because bears get trapped here, they get out here, they buy back their shorts, and it goes. Here's another form of a double bottom, but it's more of a retest. And there's another double bottom right here, but this is a range bound double bottom. The important thing is to be buying double bottoms instead of shorting them thinking it's going to reverse into the EMA. Double top flags. Here is a 2-day bear flag. We have a big gap down, pull back. This is the first pullback and we sell off. The next day we have a big gap up. However, it's a lower high and they don't reach previous day's high, creating a double top. So here's the sell off and the double top. And then within this double top, there's a double top right here. Sell off, pull back, double top, sell off. So bulls buy the first top here, they buy lower, they buy more, they buy here, and they get out their position, creating enough selling pressure for a few legs lower. Bulls that get trapped on this candle buy more on this candle and they scalp out here, and then that adds to the selling pressure. I think this was a really good example of fractal price action, how double tops work on a bigger time frame and the 5-minute chart. Trading range breakouts. Sometimes the market can form a trading range at the open. If the average bars of the range are smaller than usual, this could lead to a breakout. It's possible to fade the range, or traders can wait till the breakout is taking place to enter the markets. So here we have a gap up and the market goes sideways for about 2-3 hours. You could be selling strong bull bars and buying strong bear bars, or you could wait for the breakout and retest. Here the market breaks out, retests the EMA and goes. Trading range breakouts bearish. So here's a trading range and it's the same concept. You could be shorting the bull bars and scalping out, or buying the bear bars. And if you were going to get stuck in this pattern, we can use the lesson we learned earlier about looking at the previous day's close, and yesterday was also a range. There was also yesterday's swing high was getting tested multiple times. So there's lots of confluences here to be short and not to get chopped up. First pullback. The first pullback in a trend is a reliable trade and can lead to a second leg. Strong trend should have 2 to 3 legs. Entering on the first pullback shows the market has already moved in your direction. First pullbacks are a good way to enter the markets if you missed the trend from open. So here's the same example from earlier. You have a strong trend from the open, breakout, pull flag, another pull, and a pullback. This first pullback, you can get in for a leg higher. First pullbacks are fractal. So here is an EMA breakout, and this is the first pullback. So you could also buy this bar and catch this leg, or you can see this leg and buy this as a first pullback. And they have a leg 2 and leg 3. It's very climactic. First pullback's bearish. So now we see this sharp sell-off into the EMA and we've missed it. You can either short this bar for a few legs lower. That's a hard sell, but you can do it. There's enough selling pressure. Or you can wait for a deeper pullback, the first pullback into the EMA after the breakout, and get short for another one. I want to point out this first pullback too, because we break out from the EMA and we have this as a first pullback. Okay, we get a leg lower. Now we have this as a first pullback. This box right here is a range, and this leg breaks out of this box's range. So that makes another first pullback right here. And that also leads to such a strong sell. That first pullback deserves its second leg. It gets weaker. This is a pretty sharp selling. This could be seen as climactic price action and then sideways to down price action. This is the end of chapter 11. Please leave any questions in the comments and I'll try my best to answer them. Thank you for your time, and if you learned something, please consider subscribing.